Hi, I'm James Varaklis, co-founder and chief compliance officer at IBEX Wealth Advisors, and I'd like to welcome you to our economic and market outlook for 2023. We're shooting this video from our new office headquarters in Bedminster, New Jersey, and we have a lot to cover, so our video might be a little bit longer than normal. Volatility was a defining feature of the markets in 2022, concluding a year dominated by surging inflation, aggressive monetary tightening, Russia's brutal invasion of Ukraine, and recession fears. What was particularly unique about the performance in 2022 was that a bear market in stocks was accentuated by a bear market in bonds, making 2022 the worst year for a balanced portfolio since 2008. A portfolio with 60% invested in the S&P 500 and 40% in the Bloomberg US Aggregate Bond Index fell 16%. The question on everybody's mind is, where do we go from here? Before we look forward to 2023, let's look back to see where we've been these last few tumultuous years.
On March 11, 2020, the World Health Organization declared the novel coronavirus outbreak a global pandemic. Economies around the world stumbled and were eventually halted, giving rise to the largest work-from-home movement ever seen around the world, as both employers and employees made every effort to balance safety with productivity. The Federal Reserve responded by distributing stimulus that would eventually exceed $6.5 trillion, and by lowering interest rates to historic lows in an effort to avoid recession.
You may recall that both stocks and bonds generally perform well in a declining interest rate environment.
With a Paycheck Protection Program bolstering worker paychecks, stimulus dollars flush in pocket, and an online spending spree in full stride, a different problem emerged. The global supply chain began to collapse due to heightened demand, factory closures, driver shortages, and logistics capacity issues. With too few dollars chasing too few goods, inflation began to rear its ugly head. The Federal Reserve initially labeled this as transitory inflation and committed to normalizing interest rates. In late February of 2022, Russia launched a brutal, full-scale invasion of Ukraine. Global sanctions on Russian energy exports caused oil to spike 65%, sending gas prices to over $5 a gallon here in the US. In a confluence of events, supply chain issues intensified, food prices surged, and inflation skyrocketed to highs not seen in 50 years. Governments around the world fight inflation by influencing interest rates. In theory, if the consumer is paying more for food, energy, and any type of revolving debt, there will be fewer dollars chasing fewer goods, thus reducing inflation. Here in the US, the Federal Reserve raised rates a staggering 7 times in 2022, totaling 4.25%. This marked the fastest rise in rates in recent history.
If stocks and bonds generally perform well in a declining interest rate environment, the opposite is true in a rising interest rate environment.
As you know, we value your feedback and had sent an email a few weeks ago asking if you had any specific questions you wanted us to address. Your responses and comments were overwhelmingly supportive, for which we're grateful, and we've selected a few to address in today's video. So, Susan, what is our first question?
Sure. Many clients have asked about your market outlook for 2023.
Yeah, that was a popular question, and I'll address that. So, after a challenging year last year, I think calmer waters lie ahead for the markets. 2022 was really dominated by surging inflation, aggressive monetary tightening vis-a-vis rate hikes, which really hurt the bond market and growth stocks. And it was further dominated by Russia's invasion of Ukraine. And 2023 will start out much the same, with all eyes laser focused on economic data that measure inflation, like the core PCE, which stands for personal consumption expenditures. And that's a metric that the Fed likes to use. If the data continue to show inflation falling, it will then open the door to the Fed slowing and hopefully eventually halting rate hikes. If and when we reach that point, I have every confidence, no guarantees, but I have every confidence that risk assets like stocks could stage a significant rally, especially those that had been beaten down in 2022, like growth stocks. Dividend-paying stocks performed remarkably well in 2022, and I see that being the same for 2023, all things being equal. If the Federal Reserve does slow and eventually stop hiking rates, I think that fixed income should rebound as well, particularly on the longer end of the yield curve. With mortgage rates more than doubling last year, I do see pressure on housing and home builders, and I also see some pressure on the consumer. So stimulus from 2020 and 2021 has all but dried up, and the consumer is no longer flush with cash. So this could have an impact on consumer spending, which makes up about 70% of our economy. Sectors we like going forward are still the needs versus the wants, so healthcare, telecom, utilities, energy, financials, select technology names, and legacy wide moat businesses. I definitely expect the next few months to be choppy until clarity emerges on inflation and rate hikes. And I think the second half of 2023 will be much better than the first. So you can look at 2023 as being a somewhat volatile path to more normal markets in 2024. So what's our next question, Melinda?
Now that rates have increased, are CDs and bonds viable investments?
Yeah, good question. We shot a video in July of last year where we had touched on this very topic. So for many years, income investors have been starved because interest rates were so low. As a matter of fact, in March of 2020, the yield on the 10-year Treasury dropped to 0.32% before rebounding, meaning that if you bought that bond at that time, you were literally earning next to nothing for 10 years. All of that changed last year with the Fed raising rates 7 times, a staggering 4.25%, which is a massive hike. While that did significant damage to the bond market and the stock market, it finally opened the door to higher yields for income investors. So today, CDs, treasuries, corporate bonds, and tax-free municipal bonds offer opportunities not seen in years, finally breathing life into some income-starved investors. CDs are fine, but they're taxable. So I like municipal bonds in particular, as the interest they pay is generally exempt from federal income tax. And if the issuer is from the investor's home state, they're also generally exempt from state income tax. So to answer your question, yes, bonds are back and they will play a pivotal role in our portfolios going forward.
Another popular question from our clients, do you see a recession for 2023?
Popular question and a good question. So while the economy is threatened by a recession in the year ahead, the fact that it is not in a recession reflects unusually strong demand in the labor market. So people are working, they're making money, and they're continuing to support the economy. If the economy begins to slow, layoffs intensify, and GDP slows, then yes, I could see a case for recession. But it's important to understand that not all recessions are alike. And I would suggest considering the following. Consumer spending is a major part of our economy. So as long as people are working, they'll continue spending. There's a limit as to how much weakness we may see in employment going forward, as employers today are faced with a structurally smaller labor force than they had in prior decades. And that's due to diminished legal immigration and a large number of baby boomers reaching retirement. And for workers, lower inflation will help boost real wages going forward. So if people are paying less for goods and services, they'll have more money in their pocket to spend on the economy. There are convincing signs that an inflation downtrend is underway. Oil prices are down 40% from their April highs. Cross-Pacific shipping rates are down 77%. Lumber prices are down 65%. Food prices have stabilized. And even used car prices are down about 15% from their earlier summer peak. Furthermore, a lack of overbuilding in the most cyclical sectors of the economy suggests that any recession would likely be mild.
So there was a reoccurring theme, not so much a question per se, but it's about the overall worry that we all experienced last year. Do you want to comment on that?
Yep. I was born a worrier, and I take my job as steward of our clients' investments very seriously. Investing is a very, very emotional thing. And when investors are worried or feeling gloomy about the future, their natural tendency is to fix it, right? And that generally means selling risk assets and stocks in particular. The hardest part of my job is talking to clients about staying invested through down markets. And down markets are actually more normal and more common than most people think. So on average, the market experiences temporary declines of 5% or more, at least 4 times per year, and they're good for a 10% pullback roughly once per year. It's interesting, the University of Michigan has an index of consumer sentiment, and if we look back over the past 50 years, we see 8 distinct troughs, or peaks and troughs. If we measure subsequent 12-month returns of the S&P 500, we see that buying at a confidence peak yielded an average return of 4.1%, while buying at a trough returned 24.9%. So that's not to suggest that the markets will rise 24.9% in 2023, but it does lend credence to taking a longer-term view of the markets. Last year was an awful year for the markets, there's no sugarcoating it, but years of market gains, primarily in the equity markets, have put many investors ahead of the game in terms of their long-term plans. Good financial advice is more essential today than ever, and staying focused on our goals, despite the challenging times in between, has never been more important. And as the late, great Paul Harvey used to say, in times like these, there have always been times like these. We express nothing but gratitude for the opportunity to work together and wish you a happy, healthy, and prosperous new year.